Start. Thank you, Jonathan. Good morning, everyone. My name is Ed Del Beccaro, and I'm co-chair with Andy out of New York City of this panel. So welcome everybody to CORFAC's virtual spring conference deal-making session. I am with TRI Commercial, the executive vice president of the Bay Area, where we have offices in San Francisco, Walnut Creek, Oakland, and San Jose. Plus we have offices in Sacramento and Roseville. So it's my pleasure to moderate today's session along with our committee vice chair, Andy Simon of Hemsley Spear in New York City and New Jersey. But before we begin, I would like to recognize and thank our session sponsor that helps make this possible with Delias, Obi Wally from Delias. Good morning, Obi, and then why don't you say a few words?
Good morning, Ed, and hello, everyone. We're excited here today to be a sponsor of this session. I'm Obi Wally, one of the co-founders of Delias. Unfortunately, this year we couldn't be face-to-face, but we get the opportunity to at least dialogue here virtually. And we've been working with CORFAC, Jonathan and team for several years, and I've truly enjoyed this partnership with the organization. As most of you may know, we have several clients within the CORFAC organization that utilize Delias. We essentially are a centralized system of record for brokerages, commercial real estate brokerages, from handling your transactions from inbox to invoice. So being able to centralize your data, manage your data, utilize that information to help you essentially at the end of the day, manage your deals and make more money. Kind of in theme with the CRE deal-making session here today. And one of the things I wanted to just spend a little bit of time on is just to talk a little bit about how over the last, especially year, technology has started to play a larger role in sort of our industry, working remotely and taking advantage of information data in an environment where your clients, as well as yourselves, are remote, right? We're not able to see each other and kind of have face-to-face dialogue like we used to, and hopefully that will change soon. But in the meantime, what that's really done for the industry is accelerated the adoption of tech and the utilization of tech. And more importantly, using it to your advantage as a company and as individual brokers as you do your business and try to grow and capture opportunities within the marketplace that we're in today. And that's really where sort of we fit in, right? We're here to serve the brokerage community. That was our vision from day one as a product. And while we have everybody on this call, we're continuing to enhance and develop our product as well. We're going to be rolling out some pretty cool features on data intelligence, comps and properties within our system to allow individual brokers and owners as well to better sort of utilize that information to capitalize on getting new clients in the marketplace, capturing new business, tracking trends, and all the other aspects that will come in handy as your businesses grow and as you continue to sort of engage in the marketplace. One last point here is we're again excited to be a sponsor, looking forward to paying attention to this session. And if anybody wants to reach out to us or feel free, you can reach me at obi@delias.com. And thank you, Ed, again, for giving us the time this morning to talk a little bit and be part of this session as well.
Thanks, Obi. We are also, by the way, one of the firms that use your product, so thank you. So now I like, go ahead.
Endorsement from the president, absolutely. Thanks, Obi.
Thank you.
It was Garibaldi, by the way. We'll just chime in. We'll just chime in here.
Official housekeeping seal of approval. Okay, without much further ado, I want to introduce our panel. First, I'll say a couple words, and then Andy. I'm a player coach running 4 offices, and my major specialties are medical, office, although I'm doing some industrial lately. That's where the action is. And now, since I'm a former developer, I'm also doing some residential land for multifamily. So Andy, why don't you say a few words?
Morning or good afternoon, depending on where you are. Andy Simon. I too am a player coach, I suppose, with Hemsley Spear in New York City. Hemsley Spear dates back its origins to 1866, making it the oldest continuously operating real estate company in the U.S. We are in Midtown Manhattan. We specialize in both leasing and investment sales, property management. On the leasing side, we do office as well as retail. My own background is primarily leasing with a minor in investment sales and capital markets. We also have related companies We're owned by the Swig, Ken Swig of the Swig family. You may know the Swig family with a substantial portfolio of office assets on both the East Coast and the West Coast.
Thank you, Andy. In fact, the Swig company owns buildings in my market right next door in Oakland. Okay, so thank you. Welcome, everybody. The goal of this session this morning is to share ideas about how to make money in the current market. This is for bottom line. The pandemic has created some major opportunities, and that's how we're looking at it in our marketplace. And our speakers today will share insights on trends that they are seeing in industrial logistics, industrial investment, adaptive reuse projects, multifamily, and triple net. So we ask you, everybody, to use the Zoom chat to ask us questions. I will monitor it, and to the extent I don't ask a question, either Joe or Andy will chip in and say, ask a question. And we also encourage our panelists to ask each other questions. So we have a few minutes. We will have time at the end. We have actually practiced this, everybody. So we'll have time at the end for some questions. So first, let's kick off with my good friend, David Pryor. We found out we share a lot of things with the Claiborne company, CORFAC International, based in Los Angeles, who will be discussing money-making trends in the industrial logistics sector. David.
Hey, good morning, everyone. Who saw the Wall Street Journal front page today? I don't know, can I get my face on there for a second? I don't know if it's possible.
On the Wall Street Journal?
Did you? Well, not on. No, I'm in the post office. But if you see the big headline in the Wall Street Journal today is "Supply Woes Slam Global Manufacturing," and that was just perfect for what I want to talk about. You know, everybody knows that the supply chain was disrupted during COVID. We all know at a personal level because all of us may have come close to running out of toilet paper. But as we get through this whole process of trying to get supply chain back online, what's happened? One of the things that we've seen also in the newspaper is yesterday, Honda and Toyota halted manufacturing of most of their vehicles in the North American plants because they can't get microchips from Taiwan. And so what does that mean for us? That means that in the longer term, what we're going to see is the reshoring or new manufacturing facilities being built in the United States to make sure that we don't have these kind of shortages again. And it's not just the geography, it's political, it's economic politics, and it's making sure that we have the ability to manufacture things without relying on friendly and unfriendly countries. I spoke Monday with one of our clients, a company called Verco Furniture. I think they may be one of the largest manufacturers of school furniture in the United States. They have a big plant in Arkansas. They have a big plant in LA. And their business has been good. It's obviously slowed now that schools haven't been open. But he complained to me that they have certain components that they export from China. They've been manufactured and they cannot find a container to ship them over here. And it's essentially halting their manufacturing operations. So they're searching desperately for containers and shipping access to get those products home. The same gentleman who I was speaking with said, David, you can't believe this. We've had people making cardboard boxes for our box furniture components for 30 years and they just dumped us. And I said, well, why would they do that? He said, well, because they're going as a sole provider to Amazon. So here we are, business is good. People have buyers and they can't get maybe 10% of the components they need or even a box to ship it. And what I want to ask the group is, are there any other examples of this sort of impact from your clients? And, you know, send a note. So what are the impacts of, as we recover? Shipping costs have gone from $1,500 to $4,000 to get a container from China to LA. And as soon as those containers are emptied, they're put back on ships and sent overseas. because they need them to fill up and bring back again. And a lot of farm products, a lot of export products, non-farm export products, they can't find a box to ship out to LA because the people just, the Chinese want to get them back to fill up with their products. Everybody's aware that the Los Angeles Long Beach Harbor is the biggest port in the United States. And right now, if you can imagine, there are 40 ships floating out there waiting to be unloaded. That's about 500,000 TEUs or 20-foot containers. The ports reported in the last week that they have broken records for import every month for the last 8 months, and it doesn't look like it's going to slow down. What we're also seeing is, and my title is Just in Case Replaces Just in Time. Warehouse rents have been increasing at an incredible pace because retailers, manufacturers, everybody who's been impacted by this breaks in the supply chain, now they want to have some inventory on hand as a buffer just in case. So we are facing severe shortages and almost day by day increases in industrial rents for good distribution facilities. I'd also like people to talk about that and see if we're getting the same sort of problems in other, large distribution markets. With such little vacancy in our market, we're having trouble moving people. We have a lot of tenant requirements. We represent from big companies like DHL down to local warehouse and logistics companies. And there's so little actual vacant property that we may make a lease on a building that's not available until May, but we're not sure that the tenant who's supposed to move out has a place to go. And it becomes a daisy chain. People are backed up waiting to move, and that's causing problems. E-commerce. You may have heard the rule that for every $1 billion in e-commerce, you need 1 million square feet of warehouse to operate that increase. Obviously, Amazon has taken 90% of all the new construction over 1 million feet in the United States, as compared to the next 9 or 10 people. It's a staggering fact. But having said that, there are other companies that are taking large buildings. I talked to my friend Mark Good from Chicago yesterday. He leased Amazon 2 1 million square foot buildings last year, and he has a large build-to-suit being done for 1,300,000 foot domestic manufacture and distribution of proprietary product. Last mile facilities, old Costco's, auto dealerships, these seem to be relevant everywhere. Yards to store containers, yards to store fleets of electric trucks to deliver the last mile. Very creative. A lot of infill property has been absorbed in Los Angeles. Be interested to hear some of your stories. So what does this mean? We all have customers that have problems, and we need to help them with those problems. We have to suggest alternatives. They may say they need a 200,000 foot warehouse when they occupy 100. We may have to suggest short-term solutions. We may suggest other things that are possible during the market. You have to counsel them realistically. But I think the opportunities here come in the longer term with the reshoring of chip manufacturing, component manufacturing for everything, plastics, and a lot of different manufacturing, depending on where you are in the country. So this is an incredible time to be in the industrial real estate brokerage business, Knock on wood, it lasts. But the way we make relationships for the future, particularly for some of the younger people, is to listen to clients' problems, offer alternative strategies, and try and provide solutions to them that you may not necessarily have thought of earlier when we weren't in such a tight market. Thank you.
Very good, David. There is one question. By the way, in our Port of Oakland, we can't ship out, and we're being backed up with all the agricultural produce that we export out of Central Valley. So that's impacting a lot of markets internally and externally. But there was a question from David Boyd. If container costs are going from X to this crazy $4,000, is that going to be inflation in every product? I know you're not an economist.
Well,
what do you think?
I do have a degree in economics, so let me answer that, Mr. Boyd.
Okay.
I don't know. Listening to our professor yesterday, it doesn't sound like it, but certainly in the longer term, it's got to impact the cost of goods. You know, a 20-foot container for $4,000, depending on what it holds, people are going to lose margin. People are not going to make money. It could be a temporary thing. I bet you I bet you someone's manufacturing a lot of containers very quickly in the market, but I just don't know if it'll cause inflation. It's got to hurt somebody and help the shipping companies tremendously.
David,
Thank you, David.
Quick question from me. You mentioned the rising rents. Can you give us a sense of where they were and where they are today, and where do you think they'll be in a year or two?
Good question.
A year ago, you could lease a high quality A building near the ports of Los Angeles for 90 cents. 6 months ago, it might have been $1.05. Yesterday, a lease was signed on a Class A building at $1. This is monthly rents, by the way. These are not annual rents. $1.25 triple net with 30 cents in operating expenses per month. So that's a round number of $1.50. That's $18 a year with operating expenses for a 175,000 square foot warehouse. And what's happened as people are benchmarking these higher rents is the landlords are aware, the brokers are aware, and prices are going up on older, more average buildings. And it's kind of a self-fulfilling tulip. I hope it's like the tulips in 1600s, but it's hard to fathom. It's hard to imagine how quickly the rents are going up. We're leasing land in and around the port for storage of containers that are to be taken off the port so that they can then be taken to a transloading facility and shipped and have the goods shipped. Land is leasing. A 7-acre site just leased for 48 cents a square foot a month. Now that's just shy of $6. So if you take a $6 rent and you capitalize that at 5%, look at the land value. Those are $100 land values in and around the ports of Los Angeles and Long Beach. That's staggering. But the advantage we have here, and I know there's a lot of other people who live near a lot of other ports, is we're still the fastest route. But I know that some of the Home Depots and Lowe's and some of the other major importers are going to Texas. They're going to the coast in the south. They're going to New York just to hedge a little bit.
Thank you. So let's move on.
David, I want to
Go ahead.
Real
Go ahead,
quick.
Joe.
I'm working on a video that you guys will see shortly. I've been doing some research, and just since the beginning of the year across the nation, industrial leasing rates have gone up 35%. That's from January 1. They've gone up 35%. And a quick case study, I just settled on a deal on a 122,000 square foot warehouse in Wilmington. We had it on the market at $4 million. We closed the deal at $4.6 million because we had 4 offers and they all bid each other up because they needed it so badly.
Yeah, and I think the point of that is, Joe, that as we price things for owners, you've got to be aggressive. It's like the $1.5 million house in West Los Angeles. There's 30 bids. You're not going to get hurt by pricing assets a little higher than you're comfortable with in this marketplace, because certainly you're going to take the highest qualified offer, but that's what the sophisticated brokers in LA are doing. They're moving their prices forward to try and meet, all we need is one buyer, and we want the highest buyer.
Wow.
On a quick side note, if I just jump in here, because you mentioned Amazon, they purchased a $200 million piece of property in San Francisco, 6 acres, building 500,000 square feet. That makes it just 400 square foot per buildable foot.
Wow.
And where is that? Is that
Off 7th Street in San Francisco, south of Market area.
Wow.
Wow.
Yeah.
Okay, well, thank you. Those are great comments. Keep them coming. So now it's my pleasure to introduce Jared. So Jared, who's in our Las Vegas office, Jared Katz. Why don't you talk about industrial investment? First, introduce yourself, and then various trends. Jared. The Senior Vice President, MDL Group in Las Vegas. And are you?
Sorry, I was on mute.
Hey, keep going.
Hey everyone, thank you for having me.
You got
my
a cell
name's
phone on? Is your cell phone on? You have an echo.
My cell phone is not on. Maybe I need to move my laptop closer to me. Can you hear me better now?
You got a sensitive microphone, but you sound good.
Okay, good. My name is Jared Katz. I'm an Executive Vice President at MDL Group in Las Vegas and a principal here in this office. And my primary focus is industrial leasing and investment sales, as well as owner user sales. So I'm here to talk to you about investment sales, which have quickly become the darling in all investment classes for all of the reasons that David Pryor just talked about. Investment sales surprisingly stayed very strong in 2020, nationwide, extremely strong here in Las Vegas. With all the uncertainty in the pandemic, it was really amazing, but it's not surprising because what it's done, the pandemic accelerated what we were already seeing with brick and mortar retail switching to e-commerce. In the fourth quarter of 2020, industrial saw $11.9 billion in sales volume, which was an 18.2 increase year over year, according to Commercial Edge. Most of this information comes from Globe Street or Commercial Edge. In January, the average price per foot for industrial assets jumped for 145 to 145 per square foot. That's nationwide. So that's actually the high mark here in Las Vegas is $145 a foot, which is now become a secondary market. I'm sure David Pryor can speak to Los Angeles or some of the larger markets. The top tier markets are probably $200 to $300 a foot. Consumers are spending $861 billion online in 2020, which is a 40% increase year over year, which is incredible. And e-commerce is still less than 10% of all retail sales. So there's still quite the runway for growth there. And the strong demand for institutional investors, the Black Creeks of the world, the Link Industrials, the East Groups, they're all entering our market. I'm sure they're entering yours as well. But I'm sure any industrial broker on this call can attest to the 2 to 3 calls we're all getting a week from new syndications and new funds that are just formed specifically for the industrial class. And 9 out of 10 of them, I tell them, good luck. I mean, you've got 50 institutional buyers in front of you that can buy at lower cap rates, higher price per foot, and they're going to strike faster. And by the way, they have more confidence in our market than you. So it's a very hard class to jump into with a new fund if you don't have relationships already. Can you move to the next slide? So e-commerce up 44% in 2020. We already talked about that. Large institutions are looking to increase their exposure in industrial over office because of the uncertainty in the office sector. Nobody really knows when office is going to come back, how long we're going to be working from home. I think it's going to come back faster than we think, but most capital is now allocated towards industrial. Low cost of capital, we're seeing interest rates below 3%. Stability. This is the main reason. The sector's gone more than a decade since it last experienced negative net absorption, which was in 2010, the economic downturn. Warehouse distribution has absorbed 35.4 million square feet in the fourth quarter alone of 2020 during a worldwide pandemic. That's the highest mark since the first quarter of 2019. So absorption has continued to grow. I thought this was really interesting. We stole this from CBRE's research team, but very interesting slide. This talks about the different sectors and how investment has grown. The dark green is during the global economic downturn, 2008 to 2010. The light green is 2019, and the blue is during COVID. Industrial investment is the only one that outperformed 2019 during COVID, which was strongly related to e-commerce and the strong demand for this space. If you can move to the next slide. This is a cap rate comparison, might be hard to see on your computers. Industrial is the light blue. We've continued to compress cap rates since 2010. There was a little blip the beginning of COVID, March of last year. Quite a few institutions backed out on deals, walked away from huge deposits due to the uncertainty of COVID. That quickly corrected itself, and most of those investors and developers are back in play. Now that I've depressed you with how hard it is to do a deal right now in the investment sector, I think that there's a couple ways that we can still make money here. First one is sale leasebacks. Get in touch with your clients that own their own real estate. A lot of them they might be having cash issues right now, especially if they're in the convention-related industries or entertainment industries. Freeman, for example, which is one of the largest convention exhibitor companies in the world, put 4 of their assets on the market for a sale leaseback. One here in Las Vegas, 479,000 feet. One in Maryland, it's 160,000 feet. That one already closed for $183 a foot. There's 17 acres in Orlando, that's a shipping yard, and there's 4.5 acres in Dallas. All of those are under contract already. Freeman's going to be in a very good cash position when they come back into the market when conventions start in the fourth quarter. And they're going to still control the real estate. They put long-term leases on all of that. As CORFAC brokers, as independent boutiques, we're not going to see a lot of the 5 million square foot portfolios that are trading. But if we focus on our niche, the local boutique investors that own, 20,000 to 100,000 square foot buildings, now is the time to get in front of them and talk about where these values are. A lot of these investors paid $50, $60 a foot for these buildings. They've enjoyed the rent increases. They probably don't realize that they've got $100 a foot appreciation on their property, and they may want to put that cash somewhere else. So now's the time to have those conversations, both with the companies that might be struggling from a cash position that own their real estate. Talk to them about what a sale leaseback looks like. Talk to your investors about what their buildings are worth. There's some portfolio sales going on in Las Vegas right now. One is owned by the Steelworkers Engineers Pension Fund. They would never talk about a sale. That project's 4 million feet. Now it's under contract. I'm guessing it's with the Black Creek or one of those players. And from what I'm told by the broker, they're paying a humongous premium. So now's the time to talk to your clients about those things.
Excellent, Jared. A question, combining a couple. In retail, are we actually seeing any of the retail boxes being converted to industrial logistics, or is it just too expensive at this point?
At this point, it's a logistical nightmare, but we are seeing it. There's actually a Sears here in Las Vegas. It's a part of a mall that was refurbished last year. Most of the big box turned into office call center space, but the Sears building that's attached to the mall has 25,000 square foot plates, I think, and it's actually 3 stories, and the docks connect to a basement subfloor. It only has 14-foot clear height. The column spacing is only 15, 20 feet. So it's not ideal, but they have it on the market for warehouse space. So we'll see if that actually trades. There's an outlet mall in Prim, which is between Los Angeles and Las Vegas, that went up to auction a couple weeks ago. I'm not sure where it traded, but the brokers had long conversations with me about what that would look like as an industrial property for distribution. So at this point in our market, it's really just a conversation. We haven't seen it happen yet, but I have a feeling it's on the way.
Has Sears rezoned that to industrial?
No, it's still zone C2.
That's going to be an issue in California, David. Some cities are not willing to rezone yet, but we're recommending it.
And you also run into issues with CCNRs.
Yes. Because the other anchors have to approve the change of use, and that becomes a veto.
Exactly.
Very good.
But I think part of the politics involved in those conversions, we sold Costco a new 24-acre site next to theirs in a coastal city called Torrance, which is where our office is. And they built a new Costco to, larger, more parking, so on. They vacated 140,000 foot Costco with 700 parking spaces. That was leased to Amazon as last mile. Now, I'm not a tax expert, but I don't know, and I don't know where the sales tax is generated, but the city was just fine with it. And the same thing with an automobile dealership in Los Angeles, right near my house. It's maybe a 70,000 foot building with a lot of parking. They put docks in and they have hundreds of vans, and the vans are, roaming the streets of West Los Angeles.
I think we're seeing that in every market right now.
One other last question, Jared. What are land prices for industrial warehouse in your market?
So we're very sub-market centric. North Las Vegas, where 5 years ago, if you were paying more than $3 or $4 a foot, I would tell you you're crazy, is now trading for $11, $12 a foot. Southwest sub-market, which distributes directly to the strip, $12, $13 a foot. Prologis was paying 7 years ago. We thought that was insane. Now it's going for $17, $18 a foot. If you can find it, most landowners are looking for $20 a foot for industrial. Henderson, we're looking at $16, $17 a foot. Lease rates are obviously driving up due to demand. We can't build it fast enough. I think we're going to see a huge influx in demand as well, with the biggest sector of our economy, which is convention and entertainment, is completely dormant right now. Many of the larger users, such as Freeman, are holding tight, but a lot of the mom and pops have shut down or downsized by as much as 80%. So when those conventions come back, we are confirmed fourth quarter, they are coming back with the World of Concrete. Those users are going to come back, and there's going to be a race for space. And we're going to be, at that time, I believe, at sub 3% vacancy. We're going to see a spike in rents.
Wow. Well, thank you, Jared. Now let's hear from Jeff Garibaldi about adaptive reuse opportunities. And he's with, Jeff, introduce yourself. He's with the Garibaldi Group out of New Jersey.
Hello, everybody. Jeff Garibaldi. We're here in northern New Jersey, is where our primary offices are. We're right across the river from Andrew Simon, Helmsley Spear, about a half hour outside of New York City. We also have an office out in Lehigh Valley, Pennsylvania, the Northeast Pennsylvania area, which is a significant industrial marketplace, probably one of the fastest growing as well. We've been around. We're not as old as Helmsley Spear, but we've been around for 101 years. I've been doing this for 44 years. I'm not 101 years old, but a veteran in terms of having been in this business for many years. Fourth generation business. My son's in the business now, so we're having a lot of fun, even in this COVID period of time, as stressful as it's been. So adaptive reuse, my primary specialty is more office and industrial, but we're primarily office industrial. And we also did a pivot a couple years back, 2 years back, getting involved with co-working operations. We have adaptive reuse is something that's it's nothing new. It's often referred to as repurposing real estate. I like to perhaps use more of the term reimagining, because I think that's what the right projects, the successful projects, they are reimagined. The days of the mind-numbing office environments they just don't cut it anymore. A lot of that has to do with the younger generation that's coming into the workforce right now. The millennials are getting older. When you look to some of the trends that we've been dealing with over the past 5-10 years, millennials, there was a real surge for people moving back to the urban areas. This COVID situation has really kind of changed that a bit, and you're now seeing that exodus, so to speak, out of the urban areas into the suburban area. We have a perhaps a better quality of life, more amenities and things of that nature. But some of the drivers that is driving adaptive reuse, a lot of it's between, you know, the mergers and acquisitions that have taken place, companies buying other companies, and the surplus of real estate that results from it. Corporate downsizing obviously has been a driver for how these properties become vacant, and then companies just relocating out of state. We have a fair amount of those here in New Jersey, particularly on the pharmaceutical side, where you got a lot of these large pharma campuses. Some of the companies may have moved out to LA, out to California, San Diego area, up to Cambridge, and you've got these large campuses that sit there. They were huge ratables for the town, the municipality, and now they're dark. And what do you do with them? You know, trying to reimagine those campuses is very key. You know, there's, as I mentioned, significant amount of underutilized, in some cases, functionally obsolete real estate, both on the retail side and the corporate campuses. A major player in this adaptive reuse or reimagination, that they need to bring the town and municipalities to the table, because the rezoning is key to make these properties a little bit more flexible in terms of what types of uses you can put in there. You know, you see the uses pretty regularly now. Residential obviously is a big redevelopment or adaptive reuse. Education, healthcare, entertainment. You know, there's one campus here in New Jersey that was formerly with Hoff on the Roche, probably had about 2.5 million square feet on it, and now it's serving as Hackensack Medical Hospital. Opened up a wing there, another part of the hospital. And then they teamed up with Seton Hall University, where they brought in their nursing school. So you're seeing a lot of this reimagining and this adaptive type of reuse of these properties come into a major play. And those towns have got to embrace it. You know, in some cases, you know, where these large campuses may have been generating $4 million in taxes to the town, they go dark. In some cases, the companies will demolish the buildings just to kind of alleviate the tax burden. You'll see a significant drop in the ratables to the town, and obviously all your services and what have you will suffer as a result of that. So the town is a major player in trying to you know, move these projects along to fruition. As I mentioned, you know, adaptive reuse has been around for many years, but certainly now it's been accelerated due to the COVID. And you know, the advances in technology and the shifting interest in this younger generation and this workforce that has really kind of driven it. The other aspect of it too, cost of construction being what it is, but you know, you take a building, you know, they go for, you know, 10, 20 cents on the dollar in many cases, not all cases, I shouldn't say that generally. I'll give you an example in a moment though, which enables the new developer, the new owner, to invest the capital to reposition, to reimagine this property. So you get the benefit of infrastructure that's in place, that's, you know, you'll be able to capitalize on that, and then redeploy new capital to kind of make this property be something a little bit more attractive to what might be the corporate users today. So if you switch to the next one, I have a video, but before you press the video though, one case I want to share with you is Bellworks in Homedale, New Jersey. We had the folks that were on the first conference call this past Tuesday. We had Greg Lindsay from the New Initiatives, or the New Cities Initiative, which is like a land plan, it's a think tank. And at the end of his conversation, he referenced, not knowing our involvement or CORFAC's involvement, but he referenced probably one of the best adaptive reuses was Bellworks in Homedale. And this used to be the former Bell Labs, built back in the 60s. It's 2.5 million square feet under one roof. It was a place where incredible invention and innovation came from. Bell Labs, the phone company, it grew, it got bigger. The company, the government came in, you know, they broke it up because it was becoming too much of a monopoly. And as a result of it, over the years, finally, this property down in Homedale became vacant. And, you know, it was generating $4.5 million of taxes to the town of Homedale. Homedale is a very, you know, not boutique, but a bedroom community in Monmouth County, beautiful quality of life. They wanted to see if we could find another 2.5 million square foot user to come in and replace Bell Labs. And it just wasn't going to happen. Everything was going the opposite direction and downsizing and what have you. So they spent, the developer spent about 4.5 years into the town of Homedale to get what they wanted to take from a single use corporate headquarters R&D and a single tenant building, not multiple tenant. They wanted to make it to where it was multiple tenants and it would be able to have any use possible, that being residential, medical, office, retail, hotel, education, entertainment. The town resisted it for 4 years, and then finally they gave up, and they gave him the approval, and they basically said to him, he wanted to create this town center, which you'll see in a moment, as well as multiple uses, but he wanted to be the town center for the town of Homedale, because it's a rural community. They really didn't have a downtown area. What they said to him when they gave him the approvals that night was, Mr. Developer, you want this downtown area? So take our library, which we have now in the bottom basement of our municipal building, and put it in the ground floor of your building. And Ralph Sucker, who was the developer, basically said, you finally have listened to me for all the 5 years I've been talking to you. What else do you have in the basement that you can bring out and put it out to the public and open it up to the public? And as a result of it, he built a 17,000 square foot, it was the anchor to the first floor of this building. And it's the town library, and it brings everybody to this building as a result of it. And Chrissy, if you could just play this video. This is a video just done this past year. It's been we've been on the project for 6 or 7 years now. We've leased over 1.2 million square feet. It's become the poster child. I don't know if everybody was able to hear that well or not, but if you go to the website, there's just a bunch of marketing materials that's on it. It's really, it's quite an incredible place. And we are now, he's branded it, he being Ralph Zucker from Somerset Development, they're a New Jersey-based developer. He's branded it a Metroburb, which is a slice of urbanity in a suburban location, where he tries to create this building and this environment open to the public. On the ground floor, we've got everything from the escapeology, if you're familiar with that from an entertainment perspective. We got virtual golf. We've got this incredible health fitness. We've got medical that we put in there, about 15,000 feet of medical. He fulfilled every promise that he made he was going to do. Even we've gone ahead to start the hotel. We're building a hotel on the roof of this building. Unfortunately, the COVID thing kind of put a damper on that for the moment. I do expect that would be coming back, once the hotel market comes back. When I mentioned earlier about, cost of acquisition, what have you, he bought this property for $25 million, 2.5 million square foot building on 275 acres of land. He had it all master planned before he closed on it, got the approvals in place. He had in his back pocket Toll Brothers. And a month after he closed on the building, he closed in with Toll Brothers for about 150 acres of land and for $25 million. So his basis was more or less zero. But if you'd seen the building, it's been completely gutted. The structure is what was maintained, and all new glass enclosures or what have you. There's about 10 miles of glass that we brought in to basically open up all these floor plates so that you open up into an atrium. But to turn the lights on costs about $400,000 a month. So it's not an inexpensive proposition. The challenge he had was it was so ambitious that he didn't have any lenders that felt were ambitious as he was to put put money into it to finance it. So he put about $50 million of his own equity into the property to deliver it. He had investors backed up with him. So it's really an incredible project. We're now doing it. We're doing one in Chicago right now. Another old AT&T building, about $1.7 million, and it's the same model, the same process. And we're just kicking that off right now. And it's been the first tenant moved in about a month ago. First tenant actually was about 2,000 square feet in a $1.7 million building. If you can imagine that, this developer is quite crazy. I think it's but it's just standpoint of what us brokers can be doing and how we can perhaps learn from this. It's just trying to be as creative out in the marketplace as these owner developers are. We're on the front line. We see of or hear of these projects that may be going dormant, and to be able to visualize what might be or reimagine what that might be is I think very, very important. One other thing, if you go to the next slide, which is an interesting renovation, which you're seeing, or reimagination, I should say, is all of your regional malls. And there's one company, the York Factory. They're owned by Hudson Bay. They own Saks Fifth Avenue and Lord & Taylor's. And those stores are all closing down in a lot of these big regional malls. And they, in some cases, may own the real estate, or they may just own the leasehold. But there was an email that Andrew Simon shared with me that came across, which is up here, caught my attention. Over 5 million square feet of ready to be converted office environments in prime suburban markets. And what they're doing is they're taking, an old Lord & Taylor. This building, I think right down here is about 160,000 square feet, 3 floors, 50,000 square feet footprints. And they're redeploying, the building and turning it into co-working, turning it into entertainment. There's all, your imagination can run. And it's just a way to try and redeploy or reuse these old assets. So eyes open for what these opportunities might be.
I'd like to point out, if I may, Jeff, obviously the reimagining of assets in suburban locations is something that's, relatively new. But when you look at a city like New York or some of the older cities with older office stock, reimagining assets has been something that's been going on for a long time. It was back in the 90s when we had a downturn as a result of the savings and loan crisis, and rents were down, Wall Street was down. We had a lot of old stock in downtown Manhattan. Some of that was converted to residential back then. Currently, there's a lot of discussion because of the depth of the hit that COVID has placed on New York. It's impacted us obviously on the office side, on the retail side, and on the hotel side primarily. There's discussion politically. There's been floating ideas of converting some older office stock in Midtown to residential. How much wind that gets in its sails remains to be seen. I don't think there's a big cost attached to converting these office buildings to residential. But on the hotel side, we had our first deal where a hotel on 6th Avenue in the 30s, old Marriott Courtyard, has been announced to be being converted to an office building. On the manufacturing side, M-zone buildings in Manhattan have been somewhat antiquated, but in recent years and accelerating during COVID, there's been a huge push towards the life science. These are as of right conversions. M-zone can as of right become life science R&D. And so there's a lot of that. There's a big push. There's a lot of government money available for grants and tax advantages to convert these buildings. And then on the retail side, there's a lot of discussion as to what will happen. There's been rumors about logistics centers being created in larger box retail in Manhattan, but to date, nothing's been announced. But I think for the cities, for the urban base, you're going to have to figure out and think out of the box the way Jeff's been doing with his group in suburban.
Hey, Jeff, Dave Pryor. Does your developer who did that, Bellworks, which is awesome, does he now have debt and equity available to him?
Yes. The lenders, the institutions are very much receptive to his plan. He's proven it out.
That's great. So what a great long story.
And we're, I encourage everybody, I'm working right now with Berger and Mike Furman down in Florida to try and find a location down there. He is looking to expand this. There's other developers that do this as well. He's got a very unique approach to it. He throws a lot of money into the marketing, into the social media, and he's not creating an office environment as much as he's trying to create a culture that people really want to come and work there. The quote I have in the bottom of the slide before, which says, from a renowned architect planner, what if the office became a place to live, create, play, research, entertain, connect, dine, incubate, broadcast, mentor, muse, learn, party, invest, or invent.
I love it.
And I got to tell you, all of that does take place in Bellworks because of the environment, the culture is created there.
Well, on that note, Jeff, we want to thank you. That's a great quote. In the interest of time, let's move on to our next speaker. So I want to introduce Charlie Krasinski with Century Realty in Pittsburgh. Take it away, Charlie.
Yeah, good morning. My name is Charlie Krasinski. I'm Executive Vice President with Century Realty, based in Pittsburgh. We work most of Western Pennsylvania and all throughout the entire state of West Virginia. We have offices based in Wheeling as well, in West Virginia. So we have a pretty large geographic area. I've been in the business for about 14 years, primarily focused on investment sales, capital markets, multifamily and net lease investments for the most part. For purposes today, and to save some time, we're going to stick with talk about the net lease investment market and touch a little bit on 1031 exchanges as well.
Hey, can you speak up a little?
Sure.
Thank
you. I think the net lease investments play a very important role in aiding transactional velocity across different product types, multifamily in particular. A lot of owners that are looking to lead more management intensive type assets and defer taxes and get into passive income. So it does play a very important role, and challenges within that market that do affect other aspects of the investment sale market. So let's talk about some of those challenges that we're seeing right now. One of the biggest challenges that I'm finding personally is trying to represent and working with several different 1031 exchange buyers right now is that the level of inventory for quality product is almost non-existent, which is creating a situation where cap rates are very compressed. For example, a year and a half ago, to buy a Firestone property with 15 years of term and some rent increases, they were commanding 5.5, 5.75 cap rates. Today, you can't touch them for under a 4.7 or for anything better than a 4.75, maybe a 4.9 if you're very lucky. Good locations, it's very tough. And part of that issue too with compressing the cap rates is that the spreads from interest rates, even though we're at a fairly low level right now, it's very difficult for investors that have to replace debt as well as their purchase price within an exchange situation. So, if you're looking at somebody that's, having to replace $10 million today, and they're only coming out with, 4.5 or even $5 million in equity, you can go in if you're looking for a good credit quality tenant. You're looking at returns at probably around 3%. Still better than a 10-year treasury, but still very, very thin. Some of the other issues that are out there in the market and investors are looking at is e-commerce is still an issue. Even though you hear a lot of people, it's all COVID, it's central retailers. You still have that pressure for people looking at, okay, for the Amazon effect. And how's that going to look 5, 10, 15 years down the road? So that is an issue. There's a lot of mediocre product out there, deals that may have credit tenants that may only have 2 or 3 years remaining, maybe 5 or 6 years remaining. Cap rates and asking cap rates are still kind of aggressive. And I think that kind of relates back to what David was talking about earlier in the industrial was, that sellers are just asking for the world right now. And and why not? Because there is such small amount of product out there. Let's see where we land. So I think that there's a disparaging on lesser desirable assets from asking cap rates to actual offers at this time. You know, what tenants are out there right now that are really good? You know, you have QSRs that are very attractive. You have pharmacies, Walgreens and CVS's are still very attractive assets, good quality credits that you can find with 15, 20 years left on them. Once again, they're still in that, you know, sub 5 to very low 5 cap rate range, which is, it is what it is. So, you know, investors that are out there in the market, they're just having to deal with that and deal with much smaller returns of their money. What can we do for our clients? Well, you know, as we are, and a lot of times even the leasing agents that are out there putting deals together, putting tenants in, finding land, you know, you have a good relationship with the owners. And I think that, you know, blending and extending some of those marginal assets and trying to get more turn, position them for the market would be a good place to start. Your exchange buyer representation today would be something to talk about clients. If it was 2 years ago and I had a client who was very knowledgeable, and he came to me and said, well, you know, I can go out and find it. You know, I can go out on LoopNet, I can go out on whatever other source, and I can probably find it on my own. And I can work with 5 different brokers. 2 years ago, maybe. Today, I think it's very important you can tell clients and listen, you should hire somebody, use me to find it. Just because of that small, that it is very, very helpful to have someone that's very knowledgeable, who knows where to look. Has some of those relationships with developers that might be able to find and peel off a off-market development or an off-market property. Those are important things. And also building relationships. I mean, just being knowledgeable in this portion of it, being able to talk to people and kind of weed through some of the misnomers they have out in the market. So here I have a case study. I'm not sure if we have any time to go through it, but this is a deal that I'm working on right now. That it is a multifamily owner and looking to exchange it. It's a 74-year-old guy that I've known for a long time, and we're going through some of these issues and trying to identify those assets. And if anybody has any questions about it, I mean, I think I've already hit on most of the points. So we'll leave it open to questions.
Jonathan, do we have time for a couple questions? At least one.
Yeah.
Does anybody have a question? So is there a trend to move from apartments to triple net investments retail?
Yeah, that's been a trend for a very long time. You know, we've had, especially here, you know, that's actually made a pretty good business on doing that for apartment owners. You know, especially guys that are here in Pittsburgh that are looking to relocate as they're looking to retire. So yeah, it's been happening for a very long time.
Well, thank you, Charlie. I don't know if we have any more time, but there's some announcements. So thank you, panelists. Thank you, attendees. Thank you, Delias, our sponsor. Now, some announcements. I want everybody to mark their calendars. CORFAC has a best practices session Tuesday, March 23rd. Webpage for announcements, times. There's a CORFAC members town hall meeting Wednesday, the 24th. And then we have a keynote speaker, Anita Kramer, will discuss Urban Land Institute emerging trends in real estate on Tuesday, the 25th. All sessions are free. They all begin 11 o'clock Central Time, 12 o'clock East Coast, and California West Coast time, 9 o'clock. So thank you, everybody. Thank you, panelists. Thank you, sponsor. And thank you, CORFAC staff, for helping us produce this. Have a good day, everybody.
You too.
Oh, great day.
Thank you.